Hi, everyone. This is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. As we do each and every week, we show you the list of the stocks that will be featured in this recording. And as a quick reminder, if there's a particular stock you're interested in, you can go directly to it using the chapters feature in this recording. Wow, lots to talk about this week. Is the big, long-awaited Fed meeting, the most anticipated Fed meeting in quite some time. And they surprised some, myself included, by going 50 basis points. Thought maybe they would just do 25. And part of the reason was that I do think the Fed's behind the curve, but I didn't think the Fed would want to come out and kind of admit that maybe they've kept rates too high for too long. And then they just go the 25 basis points. Not only did they cut 50 basis points in front of the election, which surprised me as well, but they also admitted if they'd seen some of the economic data by the July meeting, they would have cut in July. So some humbling commentary from the Federal Reserve, at least from Chairman Powell. I don't think we would have seen that kind of chatter back in the Alan Greenspan days, but the market certainly seemed to like it, which we'll get to the charts in a minute. But if we take a look at the next chart, you'll see there's some work to do here on the Fed funds rate. And by the way, the Fed fund futures was a toss of a coin between 25 and 50 basis points by the time the announcement came out. But you can see where the rates are. We're kind of back in that area before the GFC occurred and rates started to come back down. And I don't think we're looking at anything like that. But if you listen to Jeffrey Gundlach, who is one of the few people that I will turn the audio on the financial networks when he comes on, one of the anointed bond kings, there's several of them out there. He had come on, in fairness, before the meeting and said he thought they were going to go 50 basis points based on his analysis of where we stood with rates in the 2-year. So he thought they had to play catch up and it would be 50 basis points. He was right. But then they interviewed him after the rate cut. And of course, he took a little bit of a victory lap, but he also came back and said that he thinks that as we go back and look in the months ahead, back to September, we're going to see that September is when we did go into recession. So he does think that the U.S. economy is going to go into recession. So we'll see. I pay a lot of attention to what he says on the bond market. Not as much on the equity side, but from an economic standpoint, we'll see if he's right. Now, let's take a look at the chart because there's some things to talk about on the chart. Kind of interesting where we are. We broke above this 565 area, and I'd mentioned that if we did break above that, we could be going to 590. We talked about that in last week's recording, and that's still a possibility. I think what's really interesting as I bring the chart out here a little bit is look at this, back-to-back dojis from yesterday and today. So a lot of indecision in the market as far as where we may go from here. So I don't even think the market is quite sure what's going to happen. We put the moving averages on. You can see we got a little bit above the 10-day moving average, that lime green line yesterday. So a little bit of backing and filling, I think, was warranted today. Testing that 565 area, which had been resistance from July and August. So all that makes a lot of sense. You break above a resistance area, you come back and test it. You don't want to break it significantly when you're overbought because that tends not to hold. So all of that would be very constructive as far as a continued move higher. But there's a fly in the ointment here. And if I take the moving averages off, I'll show you what I mean. I think you can see it in the chart here where we have that resistance area at 565. And then we have this pretty nice area of higher lows here, creating this pretty well formed, honestly, ascending triangle, which means that we're going to see some sort of a breakout on the S&P, and it could be rather significant. We go all the way down to 510 on the low. You measure the mouth of the triangle. That question was asked in one of the previous recordings is how do you know how far a triangle is going to break? You measure the mouth. So you look for where's the high, where's the low. So that amount of price range you take from the point of the triangle and say that can go either direction. I like to look at a target of 80% of the mouth of the wedge price-wise because that's where you get the greatest amount of volatility in options. The last 20% tends to be a slower move and the IV comes out. So that's the general idea. So from 510 to 560, 50 points on the SPY is what we're looking at as far as a potential move. So that's going to be really interesting to see, especially when we're in a time when usually the market kind of is range bound going into the election and the breakout comes after the election. So let's see what happens there. But some other interesting things to look at. Let's look at rates. If we take a look at the TNX you'll be able to see that rates did bounce up a little bit, which I think is kind of interesting. The Fed cuts 50 basis points, and yet we go up in rates on the 10-year. And then if we look at TLT, prices coming down. Remember, they're inverse because TNX is showing you rates, where TLT is showing you prices. TNX on the 10-year, TLT on the 20-year, so a little longer on the curve. And the bond market is still screaming recession. I know that we uninverted on some of the crossovers, but not on the 3-month, 10-year. That's still inverted. And that's one of the ones that the Fed looks at, which is probably why they went 50 basis points, thinking that they're behind the curve. That's still showing recessionary tendencies in the economy. Why, when the Fed's cutting rates, are we getting a bid in the bond market on the 20-year, and yet rates are going up on the 10-year? I know things are coming back into being back into correlations where they're supposed to be, but that 3-month, 10-year is still a fly in the ointment. Maybe one day we'll do a whole bond market scenario here. Now let's take a look at the dollar, which I think is where things get a little bit interesting. When we look at where we are, we're starting to break below that 161.8% level. Rick Santelli, another guy that I'll turn the volume on when he comes on the financial networks, is very concerned about the dollar. He thinks we're going to break below 100. The next level of support, I've drawn the line there, is at 99. Perhaps that's where we're destined to go with the dollar, but at least we got a little bit of a bounce back. But if we lose the dollar, then we have a whole lot of other problems to worry about from an economic standpoint. So we do want to see the dollar hang in there. I've been happy that the dollar has been in this trading range. I think that's been constructive for the market, staying lower but not falling apart. But if we do lose it and it starts to break down, we get below 99, then it starts to get really interesting. We could even have a Katie bar the door scenario in the dollar, and we definitely don't want to see that occur. Looking at the VIX, well, short-lived time above 17 and a half. I was wondering whether or not we could talk about this in TradeFinder. We'll talk more about that a little bit later on. 17 and a half was actually going to be support now, and that we were going to have more volatility going into the election. But nope, back below 17 and a half, back in that trading range between 12 and a half and 17 and a half. And now we're going to have to turn around and break back above that if we're going to start to look at anything other than being in this trading range on the VIX. So perhaps a quiet time being forecast here, but that doesn't jive with that ascending triangle on the SPY, or does it? If the VIX does come down enough, so if the VIX starts to come down a lot and the volatility really dries up, that does correlate with consolidation in a pattern like a triangle and could be yielding to a breakout. So it's not there now, but in the next couple of weeks, we could see those two actually come into alignment there with the forecasted move. Now we look at the Dow, which is where things have been. We actually had a case study consideration in TradeFinder on the Dow. Again, talk about TradeFinder more in a minute, and it went right up to the target that we had forecast on the DIA in TradeFinder. And so there we go. To this wave 5 at 56%, a little bit of a move back today. We look at the moving averages, also a little bit above the 10-day moving average yesterday, so it was backing and filling today, but very constructive. Now we just wait to see how far that wave 5 can go. Since the wave 4 is right at the 38.2% fib level, you look for a 61.8% extension. We're not too far away from that, so we have to wait and see, is the Dow going to be the place to be, or did these rate cuts bring the tech sector back in? Let's look at the Qs. When you thought, well, maybe they're going to just go away and drift off, and we're going to be looking at more defensive stuff. But that 50 basis point rate cut may have brought the tech sector back into focus here. I think it did. We had this zigzag pattern that we looked at last week. I wasn't sure we're going to be able to break this A wave high. We still haven't done that, but at least we have the opportunity now. Once again, on the high yesterday, a little separation from the 10-day moving average, back in and filling on the Qs. That's the theme for these last couple of days, or at least for today, ending the week. uh, is the backing and filling. But we let that 10-day moving average catch up. We could break above that A wave high and fulfill that C wave extension on the cues. So just when I thought maybe that wasn't going to materialize, you have to keep that in the back of your mind that that's a distinct possibility now. Now let's look at the IWM because holy cow. One of you commented, want to meet me at 190. I don't think we're going to 190 on the IWM now. It's back up here and looks like maybe the new range is 205 to 225. We talked about that in the insiders meeting last night, which is something we do for alert subscribers at ewotrader.com on Thursday nights. So resistance clearly at 225, support clearly at 205. You know, if you've been watching, the IWM likes to move in these 20-point ranges. So perhaps that's where we are. So maybe we start to move back down towards 205, but not sure we're going to get back to that level down at 190, at least for quite some time. Kind of interesting that the small caps liked this move by the Federal Reserve as much as they did. It seems to have brought a little bit more of the risk appetite back to the markets in general. Let's look at the crypto world, and big news here with Bitcoin is we got back above 60,000. So that's important. We needed to do that. And the next level that we're looking at here is 65,000. So that's what you're going to watch on Bitcoin. Can we get above 65,000? If we can, then we got 70,000. So we have now, remember when it was Bitcoin was in the 4,000 block moves? Seemed like every 4,000 was a stair step type of a move in Bitcoin. Well, now it's at 5,000. So 60,000 to 65 to 70. So looks like we're going to hold 60,000. So that's constructive. See what happens when we test 65,000. If we can break above that, then we can disqualify this 5-wave to the downside pattern. It's barely qualified with the wave 4 right at 70%, but it is still technically qualified as a 5-wave to the downside pattern. But we break above 65,000, that goes away. Then we look at Ethereum, which has really been struggling with 2,500. And look, it managed to do it today. Finally, we managed to break above that 2,500 level. Now let's see if we can add a little follow through. If you watch me, you know that I think one day is meaningless when you break out of a triangle, break a major point of support resistance, major moving averages, whatever. One day is meaningless. You have to have that second day, a follow through or a confirmation day. And for now, all we did was go up and hit that 50-day moving average. So we did close above 2,500. And I know it trades 24/7, but we do get end-of-day prints for charting softwares like this. And we're right here at the 50-day moving average. So we'll see if we can break above that and move up towards 3,000. But first things first, now we need a follow through day. So we need a second print above 2,500. And then if we get that, we'll start looking about that 3,000 level. Now let's look at natural gas, something we've talked, and I've mentioned TradeFinder quite a bit already, but gosh, we've talked about it a lot in TradeFinder. And since I've mentioned it so many times, if you're wondering, what am I talking about? TradeFinder is a webinar that we do every Tuesday at 1 p.m. Eastern time. So it's during market hours. It's free. You can register using the link that you see on your screen. We talk the markets. We look for trade ideas. I gave you a couple of them that we had already that have worked out really well. And we have a live Q&A at the end. And it's a great community. They ask great questions, good interaction. Love to have you join us. Like I said, it's free. So come join us next Tuesday or this coming Tuesday. And we take a look here at natural gas. It has always been a favorite of our viewers, and we finally got above 15. Look at that. We've been trying for so long to get back above 15. We broke below it in July and just haven't been able to make it with multiple tests at that level. Once again, same theme I was just talking about. One day doesn't mean anything, but this is something to really keep an eye on, because if we can get some follow through on natural gas, it almost seemed like the shorts were there and they were just drawing a line in the sand at 15 and not going to let us get above it. But if we could get some follow through, get a confirmation day above 15, we could be off and running on UNG. Look at this move down from above 20 all the way down to 15. There's nothing in the way as far as resistance, but we have to have that confirmation, because one day can be a head fake. So look for confirmation, follow through on natural gas, then perhaps that's a good place to look for a bullish trade. I think that's going to be really interesting to keep a close eye on. Let's look at the metals that have been acting pretty much as you think they would on a rate cut. It was kind of wild because on Wednesday, gold took off right after the 50 basis point rate cut and then came back down and actually closed on the low of the day, which that was unusual. But it did hold the 10-day moving average, as you can see, and jump back above it. And if you like this software, go to hub.com, HUBB.com, get a copy. You can get these live Elliott wave charts. You can get live intraday Elliott wave charts. And there's a subscription there. They have AI signals, which our subscribers at Evo Trader are very familiar with. And if you want access to those, there's a founder special, and you can get grandfathered in. It's the way of the future, AI. And if you're not trading with AI, you're trading against it because other people are using it. And I think the Hub folks are way out in front of everybody else with their use of it. So go visit hub.com, learn more about it. But looking at GLD, we moved back up on Thursday. So it was like no harm, no foul. It just was really odd what happened on Wednesday. Rallied up, closed back on the low, and then, okay, right back, got it all back on Thursday, and then a gap up and a continued run today on GLD. And SLV, talked about could SLV catch up? And one of you guys commented that, hey, yeah, SLV can play catch up in a short period of time. And yeah, it can. It's catching up rather quickly. It's still not up to where we were in GLD, but we're getting there rather quickly. And the move today is important because it's breaking above the bottom of that tap box. That stands for time and price projection, which is that Elliott wave forecast, which you can see was spot on with silver. We hit it back in May. We actually got there early. And then the lower end of this acted as resistance in July and then again here in September. But now it looks like we're trying to break above that area. And if we can, then perhaps silver does catch up to gold and they both take off and run. You would think that that would be a place to be with the Fed cutting rates and seeming to cut rather aggressively. So let's take a look now at oil. This has been kind of interesting with the bounce here. Now, this is a bit of a dichotomy, I think, on oil. So which one wins here? You would think that with the Fed cutting rates, interest rates going down, that would be bullish for oil, just like commodities, et cetera. But if Jeffrey Gunlock's right and we are into a recession or just starting one, are people going to be driving as much? Is the usage going to be there? Supply and demand always matters, no matter what market you're talking about. And so I think that there's a bit of a conundrum here, if you will, on which way we go from oil. Be curious as to what you think. Where do you think oil is going to go from here? Do you think it goes to the upside or the downside? We'll wait and see. I think it's exactly that. It's a wait and see. We do have a well-formed 5-wave to the downside Elliott wave pattern. The wave forward just under 50%. And so that could play out. And I could see a scenario where that wave 5 works and we go down and hit that target down around 60 or so. But I could also hear an argument that with the Fed cutting rates, that we could continue back up, at least back up to the point of this triangle around the 77.5. And that would surely disqualify this Elliott wave pattern. So, yeah, it's a point of flux here on oil. So for me, it's a let's wait and see, let it tell us what it's going to do, and then react accordingly. Now let's move into some stocks of interest. And I kind of mentioned that y'all make comments, some of the comments that you've made. And just as a quick reminder, every single month this year, we're giving away one of our level 3 subscriptions. That counts the time strategy, which is a sideways-based strategy. That looks for stocks that have had a big drop and stay in a trading range. AI tells us the likelihood is going to stay in a 1 standard deviation range. Then the volatility strategy, which we utilized on USO. Oil for one, these breakouts, you've seen all these triangles that we've been showing here. And then also the AI-based impulse strategy, which is directional, which has been on fire over the past couple of weeks. You get all of them. That's why it's called level 3. So if you were to go to the website, you can see it's thousands of dollars. And we're just giving away one every month just by posting a comment under the video. That's all you have to do to register. So post a comment. A lot of you last week were back with the Chuck Norris one-liners. I always enjoy reading those. Post your comment on where you think oil's going to go. Be fascinated to know what you think there, or just any comment that you want. And I love the interaction. and I read all the comments. I answer as many as I can, time and travel permitted, but I always read them. And that's where these stocks of interest come from. So the XLF, you can see that we broke out of this ascending triangle, and now we have a zigzag here, which I think makes sense. Financials should do pretty well with the Fed in a rate cut cycle. So the B wave corrections right there at 50%. So that brings us up to a potential 100% extension. That would get us all the way above 48 on the XLF. We got to get above this A wave impulse first, though. So a little bit of resistance here at 46. That's constructive, as I mentioned earlier. You don't want to break above a major point when you're already overbought. So allowing the 10-day moving average to catch up. Let's see if we can break above 46. If we break above 46 on the XLF, I do think we head to 48. And then for our folks down under, we have a lot of subscribers and viewers from Australia. I love Australia. I've been there over 20 times. Spent a great deal of time down under. And so you ask about these, and these are actually the charts from the ASX. And so I thought we'd look at BHP. It's going to probably kind of move with what oil does, you would think. The wave 4 right around 50%, the wave 5 at 50%, which means that wave 5 could go lower. So if oil does turn and move down in its 5-wave pattern, I think we could see a further move down in BHP. But if oil can hang in there and not fall apart, then you may see at least a move back up, which is what the Elliott wave pattern suggests, back to the previous 4. And then we have to take a look and see. You probably note on the chart that there's a pretty good amount of resistance right there at 42.5, which is not too far from where that wave 4 level is. So if oil doesn't fall out of bed, I do think we continue to see BHP move up towards that wave 4 and 42.5. But we'll see what happens with oil from there. And then Rio Tinto. This is a stock that I used to trade all the time. It was one of my favorite stocks for a long time. Then they had a big split, and it took some of the volatility and luster out of it for me. And you can see that we've been working our way down. We actually had a wave 5 that was extended, moved past the target here. Here's that Elliott wave 5 tap box target from the algorithm within the software. And we broke below that. Now we're moving back. Now, the key thing to remember here is when you have a wave 5 that goes more than 100%, you don't go back to the previous 4. That's not the target you're looking for. You look for a 61.8% corrective move. So that's what we would be looking for out of Rio Tinto. And so that gives you a move not too far from where we are now. So there's the fib retracement. So right up to the 61.8% level. As I said, is not too far away, about 117 or so. And then we would have to take a look and see what happens then, because that's what it's supposed to do. Once it gets there, then you take a look and reevaluate. Tesla, quietly, which I say that quietly because it doesn't seem to be screaming all over the news every day like it once was, is continuing its upward breakout of this symmetrical triangle. Talked about that with the volatility strategy. This is the kind of thing we look at, these triangles. Very nice symmetrical triangle here. Nice upward move. This is my favorite breakout, by the way, out of a triangle. Sometimes they go vertical and come back down. Sometimes they break out and are false breakouts, but I like it when they break out and just meander along that 45-degree angle. So the first target would be back to the midpoint of this triangle, which is not too far away at 250. So I think we see Tesla at 250. And then that would be about what we're looking for out of the width of this triangle here. So maybe some resistance on Tesla at 250. So a little bit higher from here, but then we'll take a look and see what happens. And then Intel, stock that's in the news right now, after hours on Friday, there was commentary that came out just before the close that Qualcomm, gosh, remember that from the days, Qualcomm, they used to say on the financial networks, was reaching out to Intel. Now, there's no evidence, at least not at this point, whether Intel was interested in talking or not, but that Qualcomm was talking to Intel about some sort of an acquisition. And so that put a bid after hours. We'll see how that plays out. The high hit the 50-day moving average and turned back down, but certainly some interest now in Intel. And with this trading range that Intel's been in since its big drop between 20 and 22.5, If it can break above 22.5, and it hasn't done it yet, it got above it, but bounced his head on that 50-day moving average and came back. But if it can get above 22.5 with follow through, then maybe we can start to talk about some sort of a continued move here. But that's going to be a stock to watch at the beginning of next week, with likely more news to come out over that headline that occurred just before the close today. Thanks as always for your time. Hope you have a great weekend. Look forward to talking again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.